There's a price everyone can see, and then there's a price that hides in the walls. The market posts the first one in neon, flickering red and green like a casino at midnight. The second one whispers through the plumbing of a business, a murmur of coins and bills traveling the pipes year after year, decade after decade. Traders argue about the first one, because it is easy to shout about numbers that flash. Investors pursue the second, because it is the quiet truth that pays the bills. That second price has an old name carved by careful hands. Intrinsic value. The phrase sounds airy until it is fastened to something that bleeds or breathes. Think of a company as a living orchard, not a stack of paper. Trees are planted, watered, and guarded from pests. Every season those trees throw fruit, some years a feast, some years a disappointment. But across the life of the orchard, the harvest can be counted. Intrinsic value asks a single cold question. If one owned the entire orchard forever, how much fruit in total would arrive in the baskets over time? And what is that stream of fruit worth in today's money, after adjusting for the risk that storms and blight might come? The modern language for that question was shaped in the 1930s by John Burr Williams, a scholar who wrote The Theory of Investment Value. He argued with patient rigor that the worth of any asset equals the present value of all cash it will distribute in the future. Benjamin Graham, teaching at Columbia and later writing Security Analysis and The Intelligent Investor, wrapped that insight in a philosophy of safety and skepticism. Graham taught students to treat the market as a voting machine in the short run and a weighing machine in the long run. The votes change with mood, the weight stays. Warren Buffett and Charlie Munger took those old lessons and carried them, like lanterns, through the murk of modern finance, proving in practice that when one buys below a conservative estimate of intrinsic value, time becomes an ally. Price and value are twins that rarely behave like twins. Psychology stands between them like a mischievous brother who swaps their hats. Daniel Kahneman and Amos Tversky mapped those tricks of the mind. Anchoring makes investors cling to the last quoted price as if it were a lighthouse. Loss aversion makes a small paper loss feel like a wound and a larger gain feel ordinary. Overconfidence lets a shaky guess masquerade as a forecast. Richard Thaler showed how mental accounting leads people to celebrate coupon savings while ignoring compounding costs. Robert Schiller chronicled how contagious stories inflate bubbles, and how those stories do not need to be true to be powerful. Intrinsic value, by contrast, is a patient arithmetic that ignores stories and listens to the footsteps of incoming cash. To feel the difference, walk through the front door of a business that became a legend in the hands of Berkshire Hathaway. In the early 1970s, Berkshire bought See's Candies for a sum that would not turn heads today, roughly $25 million. See's did not own a silver mine or an oil field. It owned customers' habits in the western states, a brand that mothers trusted and lovers reached for on holidays. The company did not need to spend oceans of money to stay great. It converted affection into cash and did so with modest reinvestment. Across decades, that quiet machine sent a river of money to Omaha. The sticker price on the day of purchase was a matter of headlines. The intrinsic value was a matter of the chocolate river, and how long and wide it would flow. Consider another Berkshire chapter. Coca-Cola in the late 1980s looked like a sugar drink in a world that worried about health, yet it owned distribution, shelf space, and memories in more than 100 countries. The market sometimes grew nervous about calories and fashion. The intrinsic value reflected something else. Could this franchise, with its global bottlers and brand recall, keep throwing off cash at high returns on capital for many years, with modest needs to pour money back into the plant? Because the answer for a long period was yes, the weight on the scale was heavy even when the votes wavered. Notice the pattern. Intrinsic value is governed by three quiet forces. First, the magnitude of cash that can be taken out of the business over its life after covering the costs to maintain its competitive position. Buffett called this owner earnings. It begins with reported profit, removes accounting fog, and subtracts the capital truly required to keep the moat intact. Second, the timing of that cash. $1 next year is not the same as $1 10 years from now. Third, the risk that the cash does not arrive. That risk is not a mood. It is the set of hazards in the business model, the industry structure, the balance sheet, and the quality of management. A risky dollar demands a higher expected return to be worth the same in today's terms. How does one handle those forces without drowning in algebra? By turning narrative into numbers carefully and numbers back into narrative honestly. Aswath Damodaran, the New York University professor who has valued everything from social media platforms to steel mills, shows that discounted cash flow is not a spell, but a disciplined story. One projects revenue growth based on actual drivers, such as unit expansion and pricing power. One estimates operating margins by studying competitors, cost curves, and economies of scale. One subtracts the investments needed in working capital and plant to support that growth. One computes taxes realistically. Finally, one chooses a discount rate that reflects the risk of those cash flows given the capital structure and the volatility of the business. Each input is a sentence that can be defended. Economists like Irving Fisher taught the world to separate real from nominal. Inflation is the silent pickpocket in every valuation. A company that appears to grow revenue by 5% while input costs rise by 4% is treading water. The orchard grew more fruit perhaps, but the price of baskets rose as well. If intrinsic value is the present worth of future cash, the worth must be measured in purchasing power, not just in currency units that melt. At the same time, one must respect the limits of precision. Michael Mauboussin has warned for years that a valuation is a range, not a point. The future branches into many paths. The correct response is humility and a margin of safety. If the best estimate suggests a business is worth 100, a prudent investor might demand to buy at 70 or 60 to protect against error and bad luck. That distance is not a cushion for comfort. It is a bridge over uncertainty. Now lift the hood of a simple, almost childish example, because simple machinery reveals the logic best. Picture a lemonade stand operated not by a first grader, but by a meticulous teenager who keeps receipts. The stand earns $5 in free cash this year, after paying for lemons, sugar, cups, and a fair wage to the operator. The neighborhood is steady. Demand grows with the summer population at a measured pace. The table and pitcher will last, but every few years the stand must buy a sturdier umbrella and a better cooler. An investor who could own the stand for life would ask, how much free cash will it produce each year for the next 15 years before the teenager leaves for college and shutters the operation? Suppose the answer, after honest guesses, is that cash will grow for a few years, then fade. Suppose the risks are mild, because the corner has little competition. Turning that story into intrinsic value means adding those annual cash amounts, each divided by a factor that makes money tomorrow worth less than money today, and then summing them. The result is a present value. If the present value is $80 and the stand can be bought for $50, there's a case. If the present value is $50 and the stand costs $80, there's only romance. Business history is a long corridor of examples where price drifted far from value. During the late 1990s, many companies had prices that implied oceans of future cash, despite business models that bled money and needed ever more capital. Story won and cash lost, until the weighing machine hauled the stories to the scale. 2 decades later, some platform firms that looked expensive on old accounting appeared cheap on a deeper view because their true assets were network effects, switching costs, and intangible data capital not fully captured on balance sheets. The method did not change. Only the understanding of the cash engine did. Balance sheets matter because creditors get paid before owners. A business worth 100 with debt of 60 may deliver only 40 to equity holders, and that is before discussing preferred shares or hidden liabilities. Enterprise value, the worth of the entire operating engine, must be distinguished from equity value, the residual claim. In times of stress, a business can be a fine orchard owned by a lender who holds the title to the land. Intrinsic value to the shareholder is therefore not a platonic form. It is a legal and financial residue after everyone senior to the shareholder is satisfied. Management is the steward of that value. Henry Singleton of Teledyne bought back shares when they traded far below his estimate of intrinsic value and issued shares only when they stood above. The arithmetic of repurchases is simple but often abused. When shares are repurchased at a price below intrinsic value, the remaining owners claim a larger piece of a pie whose size has not changed. When shares are repurchased above intrinsic value, money is burned to buy bragging rights. Buffett has repeated for years that wise repurchases require discipline, not just spare cash. Intrinsic value is the yardstick for every capital allocation decision, from acquisitions to dividends to debt issuance. Accounting creates its own mazes. Reported earnings can be flattered by deferring maintenance, starved by heavy investment that will bear fruit later, or muddied by non-cash charges. Owner earnings, the cash left after running the place properly and reinvesting what is necessary to keep the moat intact, is the metric that matters. Companies with large moats, like See's Candies, require less cash to defend their castles. Companies in commodity lands must keep rebuilding walls after every storm. Two businesses with the same reported profits can have very different intrinsic values because one devours cash to stand still while the other glides. Industry structure may raise or lower the discount rate the market demands. In fields with many rivals, no switching costs, and low barriers to entry, excess returns invite attackers like light invites moths. In fields where customers are locked in, brands are trusted, regulations form a high fence, or scale economies lower unit costs as volume rises, cash flows are sturdier. Michael Porter's 5 forces offer a practical way to think about durability. A strong position against suppliers, customers, entrants, substitutes, and rivals translates into cash that arrives on time. Time itself works strangely on intrinsic value. When a company earns high returns on incremental capital and can reinvest a large portion of its earnings at those rates, value grows not linearly but almost like a tree that not only bears fruit but throws new seeds that sprout more trees. That is how a modest candy company bought for a modest price can become a phenomenal engine over decades. The opposite is common too. A business that earns low returns and must retain nearly everything to grind forward can report growth, while destroying value. Growth and value flirt, but they are not married. Investors who mistake price momentum for value creation become vulnerable to the oldest ghosts. Herding is comfortable because it feels safe to be wrong together. Confirmation bias feels like research, because it searches only for supporting evidence. Recency bias whispers that the last few years are the future. Kahneman warned that slow thinking is hard and expensive, yet it is the only thinking that respects intrinsic value. The remedy is a written process. Base rates drawn from long runs of industry data and pre-mortems that imagine failure before committing capital. What then is the practical craft? Begin with a plain description of the business in language a bright teenager would understand. How does it make money? Who pays? Why will those customers pay again? Next, lay out the unit economics. What does one more customer cost to serve, and what gross profit does that unit produce? Study history and peers to anchor margins, and reinvestment needs to reality. Forecast fewer years than your optimism would prefer, because uncertainty widens with distance. Choose a discount rate that reflects the real risks of the cash flows and the capital structure, not the hoped-for returns of the investor. Calculate a range of values under optimistic, base, and pessimistic scenarios. Demand a margin of safety that widens as business quality narrows. Then wait, with the patience that the market punishes in the short run and rewards in the long. 2 final parables help fix the idea. In the first, a bookstore sells first editions and a tourist drops in on a rainy day. The sticker prices are scattered. The owner, a quiet woman with a pencil behind her ear, knows something the tourist does not. She knows which books will be sought by collectors 10 years from now because of signatures, print runs, and literary reputations. The sticker price is noise. The intrinsic value lives in a future auction room. In the second, a farmer sits on a porch counting the calves born each spring for 20 years. Buyers in town look only at the size of the herd today. The farmer knows the bloodlines and the land's carrying capacity. He knows the herd's future births. He is valuing the stream, not the snapshot. Intrinsic value is not mystical. It is the present worth of all the cash one can sensibly take out of a business during the rest of its life. It bends to the math of discounting. It listens to the realities of competition and capital allocation. It speaks in the language of owner earnings and margins of safety. It bows to the psychology of markets, but does not worship it. Its enemies are haste, fashion, and precision, without understanding. Its friends are patience, curiosity, and the humility to update when facts change. One can leave the casino lights to the tourists. In the back of the house, down a hallway lined with ledgers and maps, a scale sits on a plain wooden table. Onto that scale go tomorrow's dollars, adjusted for risk and time, piled one by one until their present weight is known. The number that appears is not the price that flickers in the window. It is the weight of the thing itself, and that weight, tested over years and through storms, is the only measure that has ever mattered.